I made over $400,000 in rental income last year, and it all started with one rental property. Buying my first rental property in 2015 gave me my first taste of passive income, and it changed my life forever. In this video, I'll break down step by step exactly how I did it so that you can do it too. I started with a $35,000 investment for the down payment. That same investment is now worth over $200,000 9 years later, while generating consistent monthly cash flow along the way. And the best part, I've spent less than an hour per month managing this property. That's right, no finding tenants, fixing toilets, or dealing with late night calls. Just passive wealth building through rental property ownership. But this wasn't a one-time success. I've replicated the strategy over and over, building a real estate portfolio worth over $10 million that's made me a financially free multimillionaire. But here's the thing, you don't have to quit your job to invest in real estate. In fact, if you're working full-time, you actually have some huge advantages that I'll cover later. Stay till the end of this video because I'll be sharing my top 3 pro tips for buying a rental property that will make you money and grow your net worth before you even close on the deal. So let's dive in. In November 2015, I bought my first rental property, a 3-bedroom, 2-bath house in Memphis, Tennessee, while living over 1,000 miles away in San Diego, California. It was 2,000 square feet, cost $155,000, and believe it or not, I never saw it in person before buying it. This was a turnkey property, meaning it was already fully renovated and ready to rent. I bought it from an investor who specialized in fixing up foreclosures and selling them to buy and hold investors just like me. By structuring the deal correctly, I used the bank's money to fund 80% of the purchase price while I put 20% down. And by the time I closed, I was already making money. So let's break down my first year of returns. Going into this deal, I expected to earn an 8 to 12% return on my investment. I was totally happy with that. But looking back, my actual return was closer to 60% per year. Here's how. The purchase price was $155,000. My down payment and closing costs were about $35,000. The rent I got my first year was $1,300 per month. The monthly expenses, including the mortgage, property taxes, insurance, property management, and maintenance, were $934 a month. So that means the cash flow from this property was $366 per month or $4,392 per year. On a $35,000 investment, that means the cash-on-cash return was around 12.5%, which is fantastic. But cash flow wasn't the only way I made money. The property also appreciated by about 8% per year, adding another $12,400 per year in equity growth. And here's the kicker. Even though I only put 20% down, I still gained 100% of the appreciation, meaning I earned a 35% return from just the appreciation alone in the first year. Then there were the tax benefits. Because of depreciation, I saved an extra $1,785 in taxes that I didn't have to pay. And let's not forget the loan paydown. Each month, a portion of my mortgage payment reduced the loan balance. So at the end of year 1, my net worth increased by another $2,237 just from the loan paydown. When you add it all up, my total return in year 1 was $20,814 on a $35,000 investment, nearly a 60% ROI. And it only got better over time. Today, that same property rents for $1,900 per month, while my expenses have stayed relatively the same. This means this one rental property now brings $10,000 per year in net cash flow, and my initial $35,000 investment has grown to be worth over 6 times what I put into the deal. Now that you've seen the big picture, let's break down the exact steps I took to buy my first rental property, starting with step 1. Building the investor mindset and optimizing your personal finances. Before you buy your first rental property, you need to start thinking like an investor. Most people never get started because they have limiting beliefs. They tell themselves things like, real estate is too risky, I need to be rich to invest, or I have to wait for the perfect time to invest. I used to think the same way until I learned the truth. Real estate isn't risky. Being uneducated about real estate is risky. And that's why I started Real Estate Skills, to break down the barriers so anyone can learn to invest and build wealth through real estate. You don't need to be rich to buy rental properties. You just need the right strategy. I started with one rental property, not millions of dollars in the bank. And when it comes to timing, the best time to buy real estate was 30 years ago. But the second best time is today. People who keep waiting for the perfect time stay stuck while property values and rents continue to rise. Having the right mindset is very important, but you also need to get your personal finances in order. Before I bought my first rental, I made sure I was financially prepared. So the first thing you should be looking at is how to boost your credit score. Your credit score plays a huge role in getting approved for a mortgage and securing the best interest rates. The higher your score, the better your loan terms. Ideally, you want a score of 700 or higher to get the best rates. If your score is below 700, start improving it now. That means paying off debts, lowering your credit card balances, and avoid opening new credit accounts before applying for a loan. Also, check your credit report for errors. Even a small increase in your credit score can save you thousands of dollars of interest over the life of your loan. The next thing you want to do is lower your debt to income ratio. Lenders look at your debt to income ratio, or DTI, to determine if you can afford another mortgage. Most lenders want your DTI below 43%. That means your total monthly debt payments, including your future mortgage, shouldn't be more than 43% of your gross income. The lower your DTI, the better your chances of getting approved with great loan terms. And here's something most people don't know. Investment property loans allow lenders to count some of your expected rental income towards your qualifying income. That means your DTI might look even better when applying for a rental property loan. Next up, you'll want to save for your down payment, closing costs, and the required reserves. Buying a rental property requires more than just a down payment. You also need to account for closing costs and cash reserves. I made sure I had enough saved for a 20% down payment so that I could get the best loan terms and avoid paying private mortgage insurance. You also need enough for closing costs, which typically range from 2 to 5% of the purchase price. You'll also want to save up for emergency reserves, which I suggest about 3 to 6 months of expenses to cover unexpected repairs or vacancies. Lenders will verify your savings before approving your loan, so make sure your funds are well documented in your bank account. Then you'll want to make sure that your financial documents are ready for a lender to view. Once you apply for a loan, lenders will ask for a ton of paperwork. To avoid delays, I make sure to have these documents ready in advance. You'll want to have your most recent pay stub so that you can verify your income. Also have 2 years of tax returns and W-2s on hand. Download recent bank statements at least a couple of months so that you can demonstrate your savings and reserves. Lenders will also verify your employment and sometimes even calling your employer to make sure that you're still employed. Be ready to explain any large deposits or unusual financial activity that the lender might see in your bank account. The more prepared you are, the faster you can move when you find a great deal. So why is this financial preparation worth it? Because I had my finances in order, I was able to secure an amazing conventional loan with a 4.6% interest rate with 20% down, and I was able to avoid private mortgage insurance. That translates to a lower mortgage payment and positive cash flow from day one. Instead of buying a rental that drained my bank account every month, I had a profitable investment that set me up for long-term wealth. Once you have the right mindset and your finances in order, the next step is figuring out how you're going to fund your first rental property. For my first deal, I went with a 30-year fixed rate conventional loan because it gave me a low 4.6% interest rate, required 20% down, and provided long-term stability. 9 years later, I have the exact same mortgage payment while my rents have increased by nearly $600 per month. But here's one of the smartest things I did. I didn't just take the first loan offer I received. I shopped around to 3 different lenders at 3 different mortgage companies. By having them compete against each other, I was able to get a better interest rate and save thousands on fees like loan origination and closing costs. Another important factor is that not all lenders understand investment properties. Some specialize in owner-occupied loans and might not be familiar with the underwriting conditions for rental properties. A lender who focuses on investment properties will know exactly how to structure your loan to give you the best terms and the smoothest closing process. Once you apply, lenders will ask for a ton of financial documents. I had to submit my 2 most recent pay stubs, 2 years of tax returns, W-2s, and recent bank statements. They also pulled my credit report and even called my employer to verify my income. Since I was buying out of state, my lender also requested my primary residence lease and explanations for various deposits in my bank account. Some of these requests seemed excessive, but this is just part of the process. So what's the biggest reason for going through all the pain and suffering of this loan application process? It's to understand your buying power. By the end of this process, you'll know how much you can borrow, what your monthly payments will be, and what interest rates you'll be able to qualify for. This allows you to make confident offers and move fast when you find a great deal. Once I completed this process, I knew that I was approved for a $400,000 investment loan at a 5.5% interest rate with 20% down. And that's when things got real. I was ready to start making offers. At this point, your lender will issue you a pre-approval letter. This is crucial. This demonstrates to sellers and listing agents that you have the funds to close, making your offers much stronger, especially in a competitive market. And here's a final pro tip. Get this letter before you start making offers. You don't want to find the perfect deal and then scramble to get pre-approved. Be prepared so that you can move quickly. Now that your financing is in place, it's time for step 3, which is defining your investment criteria so you know exactly what to look for in your first rental property. Not all properties make good rental investments. A great deal on paper can turn into a financial headache if you don't set clear investment criteria from the start. Here's exactly how I defined my criteria for my first rental property and how you should too. So personally, I was looking for a property under $300,000 where I could put up to 20% down and cash flow at least $200 per month while making a cash-on-cash return greater than 8%. I also wanted it to be completely managed by a professional property manager so that I wouldn't have to spend much time on it. The goal was to make a solid return on my money without adding stress to my daily life. So let's talk about picking the right market for your first rental property. Where you buy is just as important as what you buy. Ideally, you start in your own city, but that's not always possible. For me, I couldn't find any cash flowing deals locally, so I had to look out of state. I focus on markets with job growth, strong rental demand, and rising home values. I wanted a property in a safe, desirable neighborhood with low vacancies because vacancies are one of the biggest expenses that landlords face. If you buy in an area with strong demand, you'll have an easier time keeping your rental occupied, which means steady income and fewer headaches. The number one rule for first-time investors is produce cash flow. My first property had to generate positive cash flow, period. I wasn't willing to pay out of pocket every month just to hold on to an investment. A common rule of thumb is the 1% rule, which means the property's monthly rent should be at least 1% of the purchase price. For example, if you buy a $150,000 property, it should rent for at least $1,500 per month. But here's the reality. Not every great investment will meet the 1% rule. My first property didn't. I bought a $155,000 single-family home that rented for $1,300 per month, a little below the 1% rule. But I was okay with that because I was in a better neighborhood with stronger appreciation potential. More importantly, after all my expenses, it still put over $350 per month in my pocket and earned over a 12% cash-on-cash return in year 1. For any property you analyze, don't just stop at the 1% rule. Run the actual numbers, which means factoring in the mortgage, property taxes, insurance, and maintenance. You should always model out both best case and worst case scenarios, so even if things don't go as planned, you can at least still break even. As you define your criteria, I suggest that you avoid major renovations on your first deal. For my first rental, I stayed away from fixer-uppers, and here's why. Less risk, less stress. A rent-ready property is much easier to manage. Faster cash flow. The sooner it's rented, the sooner you'll start to make money. No surprises. Major renovations always cost more and take longer than expected. I nearly bought a fixer-upper duplex because I thought multifamily equals more cash flow. But the rehab would have been too much for a first-time investor. Instead, I went with a rent-ready single-family home, and it was the best decision I could have made. If you're new to real estate investing, start with a property that needs minimal work, something that can be rented out right away or with light cosmetic updates just like paint and flooring. So let's talk about finding and analyzing rental properties. Where do you actually find good rental properties? The best deals are found where serious investors look. Here's where I focused my search. I primarily look at the multiple listing service or the MLS. This is the main database where all properties listed for sale by real estate agents appear. The MLS has been my number one strategy for building an 8-figure portfolio across multiple states. If you're a beginner, this is where I recommend you start. You can also look at property listing websites such as Zillow, Redfin, LoopNet, and Realtor.com. These are public versions of the MLS, and they're great for searching for out-of-state deals if you don't have direct MLS access. You're also going to want to network with investor-friendly agents. Building relationships with the right agents is a game changer. In fact, I met the investor who sold me my first rental property through a referral from another investor I connected with. That one introduction put me on the fast track to building my portfolio. Then there's direct-to-seller marketing. This means finding deals directly from homeowners through cold calling, pay-per-click advertising, sending direct mail, and yellow letters, or even driving for dollars. These methods can uncover hidden opportunities at deep discounts, but they require time, effort, and substantial marketing costs to generate leads. You can also find great deals for free through wholesalers who are essentially deal finders for real estate investors just like yourself. Once I found a potential deal, I had to run the numbers to make sure it would cash flow. So here's exactly what I did. I first checked out the rent prices in the area, so I looked at websites like Rentometer, as well as looking at Zillow rental listings, and there's a tool called Zillow Rent Estimator where you can simply type in your address and get an estimate as to what it might rent for. I also consulted with a local property manager to make sure that the numbers I was using were in line with the market rent. Once I came up with the rent amount that I felt comfortable with, I then determined what the property expenses were. I subtracted the mortgage, taxes, insurance, property management, and maintenance from the rent amount to calculate my true monthly cash flow. With every deal I analyze, I use my deal calculator. So I run all my numbers through my rental deal calculator, which I still use to this day to analyze every single deal. If you want the same rental calculator that I've used to analyze thousands of deals and buy millions of dollars worth of investments, click the link in the description of this video to get a copy of it for free. So even with the rental deal calculator, you're always going to want to run the best case and the worst case scenario numbers. Assume higher expenses, lower rent, and potential vacancies so that you're never caught off guard. Once I found a deal that checked all the boxes and met my criteria, it was time for the next step, which is submitting offers and negotiating deals. Let's get into it. If you want to buy a rental property, you have to start making offers. I always like to say, if you're not making offers, you're certainly not making any deals. Many new investors spend months or even years analyzing deals, but never take action. I knew that if I wanted to build wealth through real estate, I had to start making offers and put myself in the game. For my first rental property, I didn't find an off-market deal or get a huge discount. I actually paid full market value because the numbers made sense and the cash flow worked. But just because I paid asking price doesn't mean I wasn't strategic. First off, I submitted a full price offer. I knew that this was a solid deal, so I didn't try to negotiate the price just for the sake of it. Instead, I focused on the terms. Second, I negotiated a seller credit for closing costs. Rather than pushing for a lower price, I asked the seller to cover some of my upfront costs, which means I needed less cash to close. That improved my overall return on investment. So let's talk about some of the specific contract terms. And by the way, if you want to get a copy of a tried and true real estate purchase agreement that we've used to do investment deals all around the country, click the link in the description of this video to download your copy now. So I signed the contract on August 25th, 2015, and I bought the property in my own name. A lot of people ask whether you need an LLC to buy a rental property. The short answer is no, you don't. There are certainly benefits to having an LLC, such as asset protection and privacy, but they also come with extra costs, and some lenders won't even finance properties held in an LLC. I ultimately chose to buy my first rental property in my personal name to get better financing terms with a conventional loan. For the earnest money deposit, I put down $1,000. My contract had standard contingencies for financing, appraisal, and inspection. I negotiated a 15-day inspection period, which was important because the first inspector I called was booked out for nearly 2 weeks. This gave me enough time to schedule the inspection and make an informed decision. I also had an appraisal contingency, which meant that if the property didn't appraise for at least the amount of my offer price, then I could back out of the deal or negotiate a better price. There was also a financing contingency, meaning my offer was conditional upon me getting a loan. If I couldn't get the loan, then I could back out of the deal without any consequences. Additionally, both myself and the seller paid our own closing costs, and I ended up using the seller's title company, which is common in a lot of the deals that I end up doing. I was also unrepresented as a buyer, which means that I didn't have a real estate agent representing me on the transaction. The seller was also the listing agent, which made negotiations more straightforward because I was working directly with the seller. The lender I was working with required a termite inspection, so I also had to get a termite clearance letter before closing. This is one of the costs that I had the seller pay. One of the best things I did was add a unique rental contingency clause to my contract. This stated that the entire contract was contingent upon the property being leased for at least $1,300 per month on a minimum 1-year lease. This ensured that my property was cash flowing before I ever closed on the deal. If the seller couldn't secure a tenant at that rental price, then I had the option to walk away without any consequences. By structuring my contract this way, I eliminated a major risk and made sure I was set up for success from day one. So I started collecting profit from the day I closed escrow. With my offer accepted and my contract locked in, it was time for the next step: closing the deal, and officially becoming a rental property owner. Once my offer was accepted, the real work began. Getting a property under contract is just the beginning. Closing the deal is where everything comes together. The first thing I did was submit my $1,000 earnest money deposit. Per the contract, I had 3 days to send it in. Instead of wiring the funds and paying extra fees, I mailed the check to the title company. At the same time, I started working closely with my lender to finalize my loan. I didn't just go with the first lender I spoke to. I shot my loan with 3 different lenders at 3 different mortgage companies to get the best rate and terms. Lenders will compete for your business, and even a small difference in interest rates and fees can save you thousands over the life of your loan. One of the smartest things you can do is work with a lender who specializes in investment property loans. Once my lender had everything they needed, they ordered the appraisal. The appraised value came in at $158,000, $3,000 more than my purchase price. That meant I had instant equity before even closing on the deal. It's like buying a stock at a discount, instant profit on day one. Next, I scheduled a home inspection. Since I was buying out of state, I did my research online, asked other investors for recommendations, and ultimately chose an independent inspector, not one recommended by the seller. I wanted someone completely unbiased. I asked for a sample report before hiring this inspector. This gave me a good idea of their level of detail, the quality of their descriptions, and the relevance of each one of their photos. When hiring an inspector, you always want the pickiest one that you can find. The inspection ended up costing me $400, which is a small price to pay for peace of mind. The property was still being renovated before I closed, so I scheduled the inspection about 12 days into the contract. Normally, I would do it as early as possible to allow time for negotiations, but because of the scheduling delays, this was the best option. Since I was financing the deal with a conventional mortgage, my lender also required a termite inspection. They specifically needed a termite clearance letter before closing. I negotiated the seller to cover this cost. I also asked the seller to pay for a home warranty, which cost them $395. This gave me peace of mind in case anything went wrong in the first year. Also, before closing, I secured rental property insurance. My first year policy cost $875 with a $2,500 deductible. I always go with a higher deductible because I only want to file claims for major events. If you file too many claims, insurers will raise your rate. I also made sure my insurance policy was a replacement cost policy, which means if my house ever gets damaged, the insurance policy will cover the full cost to rebuild. I also added loss of rents coverage for up to 24 months, which protects me if the property becomes uninhabitable. Since I was buying the property in my personal name, I also secured $2 million in general liability insurance. This is critical because it protects you from lawsuits related to the property, which is especially important if you don't hold the property in an LLC. Since this was my first rental property, I wanted to see it in person before I ultimately closed on it. So I flew out to Memphis, I met the seller and I met his team, and I walked the property for myself. They also gave me a tour of different neighborhoods and even showed me some of their other rental properties. Afterward, they took me to Corky's Barbecue, which is a Memphis staple. I got the ribs, and as a self-proclaimed foodie, I have to say it didn't disappoint. They knew the way to my heart, great food, and a solid investment deal. Before closing, I carefully reviewed the final closing statement. Always double check for hidden fees. You'd be surprised what can get slipped in there at the last minute. You can also review all the fees line by line and see if there are any items that you can potentially negotiate with the closing company. Once everything was finalized, my lender gave me the clear to close. I opted for a mobile notary, which cost me $200. Instead of going into an office, they came to me with all of the documents that I needed to sign. They walked me through every single page and told me exactly where to sign, and they were able to notarize the documents right on the spot. Finally, I received the wire instructions from the title company and I wired my down payment and closing costs. After that, it was official. I closed on my first rental property in November 2015. With the deal closed, I was now officially a real estate investor. Once you close on your rental property, the real work begins. Let's talk about managing it. And as a new investor, especially if you're buying out of state, the best decision you can make is to hire a professional property manager. I knew from day one that I didn't want to deal with tenant issues, maintenance calls, or rent collection. I wanted this investment to be as passive as possible. Since my property was over 1,000 miles away, hiring a professional property manager was a no-brainer. Let me tell you, not all property managers are created equal. A great property manager does way more than just collect rent. They screen tenants, handle maintenance, and make strategic decisions that maximize your cash flow. Before hiring my manager, I reviewed their property management agreement carefully. The key terms I focused on were their management fee as a percentage of rent collected. Industry standard is about 6 to 10% of the rent collected. I also look for leasing fees, which they collect for placing a new tenant. Half of 1 month's rent is usually what I look for in a fair leasing fee. I also looked at their late fees and how they're split between the owner and the manager. Some companies will keep all of the late fee, but I wanted to collect a piece of it for myself as well. I also look at their markups for repairs, which in this case, they didn't have any, which was great. Some management companies will also charge junk fees, so just make sure that they're not nickel and diming you to death. Here's a pro tip that most investors overlook. I negotiated to increase the late fee and have it shared between me and the property manager. This way, the manager has an extra incentive to collect rent on time and aligns my interests to ensure that they stay on top of late payments. I also set up a direct deposit so that my rental income will be transferred straight to my bank account every single month so that there's no waiting for checks in the mail. Most property managers have an owner portal where you can log in and see everything in real time. This includes rental payments, maintenance requests, financial reports, and more. If your property manager doesn't offer this, you might want to look elsewhere. Here's what one of my property owner statements looks like. You can see the rental properties, the income, and expenses all in one simple statement. If you look at the bottom, you can see the owner distribution. This is the money that gets sent directly to my account from my properties that are managed by this company. This is what we call passive income or mailbox money, which is my favorite type of income to earn. A big reason I hired a property manager was to ensure that I had a high quality tenant from the start. Here's some of the ways that I expect them to screen my tenant. First, they do a credit and income check, making sure that the tenant can afford the rent. They'll also look at past landlord references to confirm that they paid on time and took care of their last home. Finally, they'll do an in-person interview to do a final gut check before actually signing the lease. But great property managers do way more than just find tenants. They also maximize your rental income. After the lease was signed, but before the tenant moved in, this tenant asked if I could provide a refrigerator. Instead of just saying yes or no, my property manager came back with a counteroffer. I agreed to provide a new fridge, but in exchange, we increased the rent by $50 per month. That fridge cost me less than $600 up front, but I made an extra $600 in the first year alone, which allowed me to entirely recoup that investment in 12 months. Even better, that tenant stayed in the property for 4 years, which means I made $1,800 in additional profit just from that one simple negotiation. And when they eventually moved out, I still had the fridge, which added value for the next tenant. Now that the property is managed and cash flowing, congratulations. Let's wrap up with my top 3 pro tips for buying a rental property that builds wealth from day one. Number 1 is always buy properties that will cash flow from day one. Your first rental property should be a cash flowing investment from the day you close. If your property is rent ready, work on securing a tenant before you even take ownership. This way you can start collecting rent immediately and minimize any vacancy losses. Never buy a deal that doesn't cash flow. Cash flow is king in real estate investing. It ensures that you can afford to hold the property long term and benefit from appreciation without worrying about covering monthly expenses out of pocket. My number 2 tip is to buy below market value. The best deals are made when you buy, not when you sell. Look for properties that can be purchased below market value to create instant equity from day one. One of the easiest ways to do this is by negotiating a discount when submitting your offers. Sellers are often willing to accept a lower price in exchange for a quick, hassle-free closing. As I like to say, an offer is better than no offer, and it doesn't cost you anything to submit an offer and try to get a better deal. Pro tip number 3 is to lock in long-term fixed rate debt. Always opt for a 30-year fixed rate mortgage instead of floating rate loans. This allows you to lock in your mortgage payment for the life of the loan and protects you from rising interest rates and saves you from costly refinances down the road. Long-term fixed rate debt is one of the greatest wealth building tools in real estate. You're borrowing today's dollars and paying them back in the future when inflation has made your dollars worth less, meaning your debt effectively shrinks over time. When you combine cash flow, equity, and fixed rate financing, you set yourself up for long-term success in real estate investing. And so there you have it. That's exactly how I bought my first rental property, step by step. If you found this helpful, drop a comment below with your biggest question about rental property investing. I personally read and reply to as many as I can. And if you're serious about accelerating your path to building wealth with real estate, I just put together a free training that will show you exactly how to find great deals and start building your rental portfolio. Click the link in the description of this video to check it out. Make sure to like this video, subscribe to the channel, and hit that notification bell so you never miss a new video. Thanks for watching, and I'll see you in the next one.